Yes, sir. Good evening, members. Welcome you all for this first program of the year, January calendar year. Very interesting topic. And FEMA, Foreign Direct Investment, latest regulation. There is lot of changes in FEMA regulation. To handle this session, we have an young and energetic speaker, Mr. Santhosh. Welcome, Santhosh.
Thank you.
I welcome all the members for this program. It's a first program of the branch for a new year. Wish you all happy new year. As you know, there is a lot of changes in FEMA, not like earlier. There will be keep updation will be happening on FEMA because India is the hub for global market. Lot of activities in exports and imports will be happening, and quite a bit of opportunities on this, and you need to update a lot. It's being a main hub, there is a lot of scope for practice. Regular updation also is required, and very few professional, as I know, very few professional practice in this area. If a combination of international taxation of income tax and FEMA knowledge with company law, it's a deadly combination for practice. And those are individuals and having some MNC clients, you need to update regularly. With this, once again, I welcome you all for this program, and I want to make an important announcement. This online yoga classes we have started for second successive month. First month it went on very well. In the month of December, again that yoga classes are continuing for even January and upcoming months also. I request members and students and family members, please register and make you benefit out of it. And we are planning to conduct so many workshops in this month. Please actively participate and update your knowledge. With this, once again, welcome you all. Over to Secretary Pramod for giving a brief introduction of today's speaker. Thank you. Over.
Thank you, Chairman. I would like to take the privilege in introducing CA Santhosh Kumar, who is a chartered accountant with DISA qualification and a company secretary. He has a vast, he is a partner of SBA and Associates, having more than 12 years of experience. He has a vast experience in internal control, process audits, internal audits, and ERP environments. He's previously worked with as a treasury consultant in being point of incorporation of USA. He's also handled various management consultancy assignments such as mergers, for operation of SMEs, business valuation, project report, and due diligence. Apart from the functional knowledge in the area mentioned hereby, he is also currently specializing in FEMA, FCRA, internal controls, and process audits. He has a credit of bringing various brands from Switzerland, Australia, Germany, and Sri Lanka by providing an end-to-end solution relating to foreign investment into in India by equities and ECB. With this brief introduction, I would like to present to you all before CA Santhosh Kumar. Welcome to you. Welcome you, sir, once again, and over to you.
Thank you so much. I would like to thank my friend and chairman of Bangalore branch, Mr. Srinivas, and CA Pramod, secretary of Bangalore branch. I would like to, it's like coming home after a long time. I'm taking a session, kind of little bit nervous also. I don't know why. After a long time, I'm taking the session on FEMA. So I would like to thank Bangalore branch for providing this opportunity. And FEMA being a very vast subject in terms of the circulars, notifications, and all. 2 hours is insufficient, but we would like to cover significant aspects which latest changes have happened, recently have happened. I would like to cover those areas. From this, we'll cover it from slightly basics to the latest updations, so we can get a kind of idea what is happening in the FEMA area. So I would like to share the slide. So can I share a slide now? Is it visible now? As everyone know, I think FEMA has undergone tremendous change in specifically last 7 to 8 years. After this BJP government, a lot of changes have happened. The changes have happened definitely for the good of the business. Earlier, a lot of clarifications and a lot of interpretational issues were there. I think government and RBI has been working very hard to ensure that the investors in India has predominantly clarity about what they are doing and what investment they are doing in India and how to interpret in majority of the cases. And in those for those reasons, I think government has started issuing consolidated FDI circular. This has been issuing from the earlier years, but now if you see the consolidated policies of FDI, you will find that more on the process side. Earlier, it was more on the rules or regulation side. Now they've started explaining in more detail so that the user will understand what is the rationale behind those regulation, and also they are covering the procedural aspect, and wherever possible they are trying to clarify the position of the government, things like that. So this has been it has helped a lot for many practicing chartered accountants and also company secretaries in interpreting the FEMA law. So I would like to, from the basics, if we have to cover, as everybody knows, that this is the Act of 1999, and which has replaced the FERA after our times, olden time. And basically, this act was introduced for managing and regulate, specifically facilitating the external trade and the payments relating to the foreign exchange in India. This is post liberalization, and subsequently they have liberalized. They have went from regulating to the facilitating, and facilitating to the now I think promoting the foreign exchange activities. So now they are into promotional mode. So they are going very very deep into the understanding the problems of the industry, understanding the investor concerns, and then they try to liberalize, or they are trying to provide a roadmap to the investors where they can invest into India and prosper the business. So if we understand the structure of FEMA, I think as everybody knows, FEMA is a very, very small act, but it is regulated, or it is governed by RBI, and RBI has been entrusted with the administration and implementation of FEMA. Under that, what they do is they keep issuing notifications, they keep issuing circulars, they keep issuing press notes, and then consolidated policies and things like that, so on and so forth. This is how the structure of FEMA runs. So they keep they keep issuing these circulars. So always FEMA has to be read with notification. It has to be read with master circulars. It has to be read with notifications. It has to be read with circulars, press notes, and all this. So, but to make it more easier for the investors, what government is also doing is on the timely basis, maybe once in a year. I think due to COVID, they could not do, but last circular was issued on 2017. After that, subsequently 2020 October, they issued the consolidated circular. This consolidated circular, what it does is that they take all the press notes, they take all the notifications, they try all the guidelines, and they try to segmentized into wherever relevant to FDIs, they will consolidate under this FDI policy, and then they try to put it in one place. So what will happen is, with that, the investors or the consultants like us, where we can always go back and rely in one document and verify whether the applicable provisions or applicable regulations have to be met, which applicable regulations have to be met for a concerned client. So it will be very easy for us to understand when it is put in one place. So when we are reading FEMA, specifically on the FDI part, my suggestion is that if you can go through the consolidated policy, broadly most of the things will be covered over there. If you cover up that and ensure that you comply to that regulations, we can do a good job to our client. So, however, this is the structure of the FEMA at this point in time, where the powers have been, provided to authorized dealers, and it has been provided to central government. Anyway, they have the policy to make rules, and also the RBI is interested with administration and implementation of FEMA. So, just to go back to the basics, so that just to before we go into the main aspect. For the benefit of all, the compliance has to be, compliance has to be taken care of. There are 4 aspects, including for us as a chartered accountants. What 4 aspects are important under FEMA? One is compliance to capital account transactions and certification of capital account transaction. As a chartered accountants, we have been asked to certify the capital account transactions when it comes to valuation, when it comes to the compliance. And even including company secretaries, so they will have to certify it, and compliance to capital account transaction. These are the 2 aspects which generally is involved. Second, under current account transaction also, we might have to comply on certain transactions, and we might have to certify on some of the current account transactions. Apart from this is specifically under FEMA, that is FDI, which I am talking about. Under FDI, the capital account transaction generally involves which is issue of equity shares, transfer of shares from resident to non-resident, and also issue of convertible notes, issue of convertible debentures. All these things, there are certain capital assets which are involved. All that will come under capital account transaction. It also involves taking loan as ECB, which is not part of the FDI, but it is part of the external commercial borrowings. That is also part of the current account transaction. But under FEMA, under FDI, we involve the issue of shares, issue of equity shares, issue of preference shares, issue of convertible notes. All this part of the capital account transaction under FDI. When it comes to current account transactions, these are all routine transactions like export and import of services. That and all comes under current account transactions. So the context of current account transaction and capital account transaction differs from company, differs from individuals also. So as far as the individuals are concerned, generally the current account transactions more of personal in nature, like personal travel, gifts, donations, transfer of money for under LRS, all that will come under current account transactions. As I said, capital account transactions are broadly classified into 3 aspects. One is issue or transfer of shares, which is FDI, investment outside India, which is ODI, and borrowing or lending in foreign currency transaction, which is ECB. So we will be all the transactions which are relating to current account transaction broadly falls into these areas. So whenever any transaction we have to execute, it will broadly, for capital account transaction, it will broadly fall in these 3 categories. So issue or transfer of shares, which is FDI, investment outside India, which is ODI, borrowing or lending in foreign currency. This is the broad categories which we can classify. If you have any questions, you can ask me then and there, so that if anything is there, I can address, or it can be taken at the end also. Now, whenever we are looking at investment into India, the first question which comes to our mind before we go into the the actual process and all is that whether the client which you are seeking FDI, or the client or the investor who is investing into India, is he an eligible investor? Is he an eligible investor, or is he an eligible investee? That we need to check in first. We have to check. If we understand that whether he's an eligible investor, then it becomes easier for us to go into the next process. Now, before going to the eligible investors, we'll look at whether the eligible investors, which are all the types of investors, they generally seek FDIs in India. One is private limited companies and public limited companies. Private limited companies, public limited companies which are classified into non-listed, unlisted, and listed. So listed has to be met with SEBI guidelines also, and unlisted will be at par with private limited companies. Second is partnership firms who are also eligible to be eligible for the FDIs, and proprietorship firms, where the rules and regulations slightly, the processes are different, but these are all the eligible investors. Even trust can get the the investment from outside India. And LLPs, other than LLPs, we have a lot of investment vehicles such as REITs, investment trust, infrastructure investment trust, and alternative investment funds. And also startup companies. Startup companies, why it is being segregated is that the government of India has given certain guidelines separately for startup companies, where they can issue convertible notes, and then we can wait till 5 years, and then there are certain benefits are there for startup companies. Other than that is the reason why it has been specifically segregated. Other than that, more or less the process for investment for all these companies are there, but certain conditions are different. So each investee has a separate condition, and it has a separate aspects of investment, separate the method in which the investment can be done, so the limit can whatever limits are there, so all that will differ. So that's about investors. When it comes to investors, these are all the companies which are incorporated outside India. The companies which are incorporated outside India, it can be in any form. It can be a non-resident entity. It can be non-resident Indians who are sitting in Nepal and Bhutan. It can be non-resident Indians who are sitting in Dubai, or it could be in UAE, US. It also that FIIs are there, FPIs are there, and companies which are incorporated outside India, trusts which are incorporated outside India, trusts which are incorporated outside India. These are all the bodies. These are all the investors which are looking to invest in India. In any form, they can come and invest in India. So there are so these are all the eligible investors who can invest in India. But for each investor or for each investor type, we need to specifically go into the conditions which are there, and that condition can differ from person to person, or from investor to investor. So that's basically the conditions will differ from each sector. Also, there are certain restrictions in which the eligible investors has in which sector they can invest, and those sectoral limits are there, and those sectoral limits has to be looked at individually. Yeah, when we know that there is an eligible investor and also an eligible investee. Now the question is whether the investment has to be done under government route or under approval route. As you know, predominantly majority of the sectors have been opened up now, and currently except a handful of sectors, everything else has opened up, and most of them are under automatic route. Only few of them under government route. Before we go into the government route or approval route, I think we need to also understand. What type of complaints needs to be done for government route or for an automatic route, or what process generally is followed for investment. I think in the case of government route, as you know earlier, we or currently also, that whenever there is a sector which is not open, which is not under automatic route, we need to go through approval route. In the approval route, what happens is the investor, before he invests any funds into India, he needs to make an application to the government of India, and through now it is online. Earlier it was offline. So we need to make an application to the ministry. Earlier it was FIPB board, that is Foreign Investment Promotion Board. Now it is to the various ministries have been allocated with under online. It will go to the particular place, and then it gets distributed. So government route, what happens is we need to make an application to the government, and only on getting an approval from government, that the company is supposed to invest in India. That means funds cannot reach India unless an approval is in place. So that is basically the government route. In the case of automatic route, what happens is you need to you can get the funds in India, then allot the shares, report it to the RBI, and then completely go through it, which is completely, there is no permission required. It's post-investment approval. Basically, it's automatic approval, means it is assumed that it is automatically approved. So as long as it does not breach the sectoral cap, as long as it does not get into the sector which has the restrictions, so the investors can go through the automatic route. So if currently there are certain sectors which are under government route, as you know, that following are the sectors. Broadly, I am giving you the broad scenario. Each one of the sector we need to go. The mining is also under automatic, and also it is under it is both under automatic and also it is both under approval also. So we need to whenever we are actually advising the client on the sector base, it's not just about a broad sector. We need to specifically go into that particular sector and then validate each conditions. For example, mining, certain aspects of the mining, like for example, coal and lignite, all that are under automatic approval. But when it comes to titanium, there is a specific minerals called titanium where they have made it as a government route, 100%, which is under government route. So we need to go to the specific sector and understand in each of these sectors and then advise the clients. On the defense also, where the industrial license is required, where industrial license is required up to 74%, you can go under automatic route, and if it exceeds 74%, then you have to go under government route. Wherever there is no industrial specific license is not required, up to 49%, you can go under the automatic route. So likewise, each segment has the government route also and approval route also. So we need to specifically understand these are all already, these changes have happened in the last updation in 2017. The circular, a lot of areas have been modified, and some of the sectors like broadcasting, and very few sectors, there slight changes have been made individually, and these sectors specifically on the space, specifically on broadcasting, specifically on digital media, these areas government have more focused and they try to put more conditions over there. These are all the areas which specifically government routes are applicable. If you want to go through it, I'll just highlight you which are all the specific changes have been happened, which will help you to understand. Specifically on the broadcasting, we have broadcasting carriage services, which more of DTH services, cable networks, and IPTV kind of thing. And when it comes to content management, earlier, for the up to 49% government approval route was there for broadcasting and news channels and all this thing. Now they have introduced one more segment called streaming of news and current affairs through digital media. So that is about up to 26% under government route now, which has been newly added. So up to 49% broadcast content services, up to 49% is under government route. So more than 49% it is not allowed at this point in time. So under uplinking of the current news channels to the existing the news channel which they want to uplink to the digital medium, that is under automatic route, because they have a complete news channel which is running, and that channel, if they want to publish over internet or broadcast the content on the internet, so that is allowed under automatic route up to 100%. So up to 100% that is allowed. So that kind of segments we need to understand, and each of these segments we need to look at it and then specifically advise. On the print media also, up to 26% it is allowed in the print media, and civil aviation it is completely up to 100% is allowed in civil aviation. Subject to conditions, there are certain conditions have been put in place, so those conditions has to be specifically fulfilled. I would like to cover specifically on the trading and multi-brand retail trading, and also the food single brand retail trading. Earlier, if you see in the earlier government, I think the 51% up to multi-brand retail trading was allowed under automatic. Up to 100% was allowed in specific states which they wanted to allow. I think that has been rationalized now. I think it is now up to 51% is only allowed under multi-brand retail trading. Wholesale cash and carry, which was already allowed at 100%, that is continued to be at 100%. So those are, and single brand retail trading earlier, single brand retail trading, which was not, which was having brick and mortar stores, they had allowed the e-commerce, that continue to allow the e-commerce, activities in the single brand retail trading. They don't need to, go for the specific, permission or things like that. They can, if they have a brick and mortar store, they can continue to do that. And when it comes to multi-brand retail trading, up to 51% it is allowed, and e-commerce activities up to 100% it is allowed, where they have They can only do the B2B selling. They cannot do the B2C in the e-commerce activities. In that e-commerce activities also, there are two models. One is e-commerce, what do you call, marketplace model, and also inventory model. Marketplace model up to 100% it is allowed. When it comes to inventory based model, the B2C activities is not allowed. It's only they are allowed only up e-commerce model where they can engage in e-commerce activities. And I think this is the other areas which you can go to the. Now, earlier, as we know that we did not had this common platform where we can file all our applications, and we didn't know what was happening to the, we didn't know whether the application was received, whether it was put into processing and all. So those stages was not knowing. So government has brought in this FIFP portal where investor facilitation, all applications to be made here. And internally, the government will allocate to the various ministries. They have also notified which are all the ministries who are supposed to take care of the application, each of the respective sector. So whenever any application is made based on a specific sector, and those sector application will go to the particular ministry, and those particular ministry are predominantly responsible for the accepting and reviewing the application. If they have any concerns, they can send it to the the applicant. And also, if they have to seek a specific permission, or if they have to coordinate with the if they have to coordinate with the other ministries, then the administrator, there is one intermediary they have created, administrative setup, where they coordinate with different ministries and get the application approved with or without conditions. So there is also another setup they have made where if the investment is more than 5,000 crores, CIC has been formed, where core investment committee has been formed, where if the application is more than 5,000 crores, and that has to be put into CIC, and wherever required, the cabinet approval is also required, that they will have to take it. So below 5,000 crores, the each respect, unless otherwise, if there is any specific reason why the ministry wants to take the help of the other ministries, up to 5,000 crores, the the ministries can take care of the approval of the applications under government rule. One certain caveats have been put in place for automatic route, which I would like to highlight. All other things are all clearly explained, but there are certain things under automatic route as a consultant. So when we are advising our clients, also we need to understand what caveat we need to explain to the clients, specifically on sectors which are very sensitive to the government, sensitive to the Indian government, sensitive to the defense, sensitive to the borders. So there are certain caveats have been put that I would like to mention, is that even though there are even though all the sectors which have been under automatic route, the caveat is that whenever the government feels that whenever the government feels that even though it is under automatic rule, the government can always review the application and can always come up with a condition, can always suspend the approval which is being provided under automatic route. So we should always keep in mind the sectors which are like defense, sectors which are like mining, or sectors which are like broadcasting, sectors like those which are sensitive sectors. Those sectors, even though it is allowed under automatic route, the government can always review those applications from national security point of view and can always restrict the further investment in those companies. Along with that, there are other two important aspects which needs to be known, that there are in 2017 or earlier to this 2020, there were certain sectors which are under government route, where we went to the government and we sought an application for approval from the government, and the government has given an approval, and further to that they have liberalized. Further to the government approval, they have liberalized and made it automatic. In those sectors, whether there is any specific, again, we have to go for the further investment and the government route. That's some question can come into the mind of the client and also to us. So the government has made it clear, or the FEMA guidelines have made it clear, is that whenever there are sectors which opened up, we need not go back. We need not go back to the government for further approval, for further investment. So the consent, it can go through the automatic route. If the sector is completely open, then it can go to the automatic route without any condition. If there is no condition which is there, where we need not go back to the RBI or we need not go back to the government for further approval, in that case, it can go through it. Where we can go under automatic route, we need not go back and seek a specific approval. This kind of clarity has been put in place in the consolidated policy, which was earlier missing. Okay. Now, just to once again update on which are all the sectors. Now, predominantly everything is opened up now. So, but just to remind us ourselves that which are all the sectors which we need to keep, telling our clients that which are all the sectors which are still not open, which is still not possible for any foreign investor to invest into India. One of the very famous and very the big sector, which is like the lottery business, including private lottery or online lottery or any franchise, anything which is relating to lottery business is not allowed in India. No foreign investment can come into place in India for this business. Even gambling and betting, including casinos, whether it's online or offline, no gambling or betting is allowed. Including online platforms. Foreign investment is not allowed. But there are certain companies which currently involved in this, but they have got the investment into the sector because they're trying to project to the government that this is one of the product or one of the particular game. They are trying to say that this is more of the gaming side. This is more on the side of the which is more on the tech side. The investment is coming from the technology and not for the activities and all. So there is a very gray area in this particular sector. If you ask me, as a precaution, we need to be very careful in advising this kind of clients, where eventually that the nature of transaction eventually amounts to gambling or eventually amounts to betting. Or these kind of companies, though they treat themselves as a technology companies, but the type of activity, the type of sector which involve at the end of the day, we need to also understand. If there is a sector where if there is an activity which are, for example, there is a cricket where they will do the the time game where they create 11 and then play over there, and they also have a product like playing pokers, playing casinos online. So we need to also understand if the client is having this kind of mixed businesses where some are legal and some are illegal. This is where the companies have to relook at their structuring of the company. Otherwise, they might get into the FEMA non-compliance. They might get a notice from the government or maybe from the ED for non-compliance in that. Even it's one of the sector is also crypto. There are a lot of companies which are getting invested. They're saying that it's on the technology front. This is that the technology on which they are creating is they are only trading the crypto over there. But when it comes to the activity as such, they are facilitating the cryptos. They are facilitating the crypto transaction, even though the tech part is there where the company, but when they are accepting the trade and they are settling the trade. So that when it is the case, it is not legal. So that is something that companies should be aware of. Next is chit funds, Nidhi company, very clearly. TDRs, that transferable development rights. Also the real estate business and also construction of farmhouses. Construction of farmhouses also involves the agricultural properties, plantations, and all this thing. They cannot, involve. These are all currently the prohibited sectors. In real estate business, they have segregated. Earlier, there was no clarity in the real estate business, whether construction is also real estate, whether construction of, whether the preparation of township or sites, or whether real estate was entirely a very big gamut of businesses were there. Currently, they have segregated now. They have brought in a lot of clarity in this sector, which helps many clients in understanding what is real estate business, what is allowed and what is not allowed. So in that, they have segregated as infrastructure. The infrastructure part, which relates to construction of roads, construction of the houses, construction of bridges, tunnels, all these things is coming under the construction of infrastructure. where it is completely allowed. FDI is allowed in that infrastructure. And they also segregated in the real estate, the development of plots, development of township. That means they create a township which has a plots, which has a retail space, which has a housing, which has, it's an integrated township. In the integrated townships, it is allowed. The real estate is allowed. Automatic route is allowed in that segment. So that they have carved out. And the third one, which is also carved out, is real estate broking business. Now there are many companies which are into broking. They are not specifically dealing in any particular, they are dealing in every type of activity, but broking specifically. The broking also, they have clarified that the real estate broking is not part of the real estate business, or they have carved out, and they have said that that is also now allowed. So now coming back to the what is real estate, what is not allowed now, in my opinion, what is not allowed is plotting of sites, the buying and selling of houses, the second-hand market. That is not like buying and selling of plots, buying and selling of land. This is the area which they have currently, in my opinion, it is restricted. Other than that, generally all construction activities, all, where the large investments are required, hotels, tourism, all the activities relating to the real estate, construction and infrastructure, it's all allowed. The another sector which is not allowed is that, cigars, which has been there from long time. And also the atomic energy currently, which is not allowed, it is completely government driven. Railway operations, I think it's railway. I would say it's not railway railway to the extent which is not allowed, which is allowed, which is to the extent which is allowed, like infrastructure, those area which is already allowed. Subject to that, it is now restricted. So currently, I believe that the operations part, railway operations part, is within the railways. Other than that, like it has already been delegated to many companies, which is subsidiary of railways, like IRCTC, like IVNL, IRFC, like that. They have segregated many activities, and that is already allowed. I think foreign technology collaboration, which I already clearly said, gambling is not a sector which is not, which is not allowed. So now, if we come to what has happened recently, which predominantly, which has happened, what changes have been brought in place in the recent update. And then in that, some of the conditions have been put in place, some of the changes have happened, and those are the information which we need to be aware of. One is when it comes to the eligible investors, as you know that there are money companies, that there are many eligible investors. In that, they have specifically, put in place after this Indo-China, after that Indo-China war happened, or maybe Indo-China broader issues are happening. They put in one condition where they said that any countries which are bordering the government, which are bordering our nation, which are attaching to the land borders of our country, those countries specifically, any structures, whether it's individual, whether it is companies, or whether it is trust, or any companies which are any structure which are incorporated, or which are beneficially held by these citizens of these countries, the investments into India is not allowed under the automatic route. That means even though our sectors may be open, that the business in which they want to invest in India, those sectors are within the limits, those sectors are allowed as per the government regulation. But when it comes to because it is beneficially held by because the investees, because the investors which are investing into India, these investors are beneficial owners and the citizens of the countries which are bordering our nation, which has a potential threat from the security point of view. They have been restricted. Now the question comes, which are all the countries which the borders where the restrictions happened? Earlier, we had restrictions for Pakistani citizens or companies which are beneficially owned by Pakistani citizens. Those companies, they cannot invest in India. And Bangladesh is also one such country where, because of this regulation, the beneficial owners or the citizens of Bangladesh, they also cannot invest in India. They can invest in India only under government route, not under automatic route. And now China is one such country, Hong Kong is one such country, and another is now there is Taiwan. So now the question is, there are many, when this regulation particularly came into place, many, including one of the requests come to me also, many of the some of the clients which are currently incorporated in China, incorporated in Taiwan, and the question come into place whether the companies which are incorporated in Taiwan, whether those countries, whether those companies, or whether those investors which are originating, or the owners which are the citizens of this Taiwan country, whether they are eligible or not eligible. That's a big question which came into place. And there were many deliberations and there were many discussions happened. But one thing there was no clarification issued by Government of India in this particular aspect. But in many of the places where they have specifically, Government of India has specifically segregated China and Taiwan as two separate countries. And as far as foreign policy is concerned also, there is an inference which is an underlying inference is there, which clearly says that China and Taiwan are two separate countries. So when it comes to the investment from the citizens of Taiwan, we always, as a matter of precaution, because there was certain issue happened in last 1 or 2 years where there were many ED raids were happened. There were many CBI raids happened on the companies which are incorporated through Taiwan, because China has invested many of the China beneficial owners have invested many of the companies through Taiwan. So there were many discussions were there where whether it is safe to consider it under automatic route or whether it is safe to do it through the government route. So that question comes into place. So because we don't know the beneficial ownership, unless we know the beneficial ownership clearly, if the beneficial ownership is translating into a Chinese citizenship, or companies which are incorporated or which are held through the beneficial ownership, which are held by the Chinese citizens, I think in a safer side, we need to go through the government route. If you clearly know that, if you clearly know and you can validate it, that the Taiwanese are beneficial owners and there is a Taiwanese passport, you need to have those documentation to come to a judgment. And then in those cases, we can say that Taiwan being a separate country, we can say that they are eligible investors, and that this particular restriction does not attract to them, and you might go through the automatic route. Now, when it comes to the other countries, specifically like Hong Kong, specifically like China, we need to be very, very precautious, and the sectors. This is a clear direction that we should go through the approval route only. And also whenever we are incorporating any company or which is already incorporated, and there are some Chinese before this regulation, there are certain companies which were already incorporated. You need to personally review, and if you find any such instances, I think we need to go for the we need to specifically on the directorship, we need to specifically review. If there's any non-compliance, we need to go for the compounding, and we need to specifically apply for compounding if it's coming under compounding route. If there is any such violation which cannot be compoundable, which is not compoundable as per the RBI, in those instances, I think you need to go for the resignation of the directors, or maybe transfer of shares from a non-resident to another non-resident based on the other guidelines which are applicable to that company. So we need to look into those aspects. And this is one of the major change which has happened in the latest time, and that is something which you need to look at it. The next one is, I think there is new changes which has happened. There's new changes which has happened. There's a new changes which has happened in the last couple of years. I think that is already governed in consolidated policy in 2020. In 2019, there are foreign exchange management non-debt instrument. There's one separate rules came into place, which they try to consolidate all the they try to consolidate all the FDI related matters into one rules, so that coming from non-resident investors, maybe NRIs or OCIs, FCCBs, including non-resident entities, and even FPIs, all these were under separate. There were the rules were actually segregated into multiple circulars or master circulars and things like that. Though there were multiple circulars, the government wanted to consolidate it and make it under one segment. So what they did is they for FPIs, for foreign venture capitalists, for venture capital investors, and even foreign portfolio investors, NRIs who are wanting to invest on non-repatriation basis, foreign non-resident Indians who want to invest on repatriation basis. These were all under different regulations, under different circulars. So they said that they wanted to consolidate, even including the acquisition of property, immovable property. The acquisition of immovable property has been spread out in different segments like LRS, even in NRIs. It was in establishment of branches, offices. Under different regulations, these were mentioned. And all these things now they have made it under foreign exchange management non-debt instruments. So different type of activities are covered in non-debt instrument. I would just like to cover. So which are all the non-debt instruments which are part of this particular guideline? So one is all the investments in any equity instruments, all type of equity instruments when it comes to, so that is part of this regulation. So earlier it was part of foreign exchange management, where transfer and issue of shares, those some of the rules and regulations were covered under that. So that are also, they have brought it under non-debt instruments, where all equity instruments, including convertible notes, including preference shares, including convertible debentures, all this part of the equity instruments. So these instruments are all been covered under one particular rules now. So that is non-debt instrument rules 2019. Now, apart from this, they've also covered the LLP, wherever the investment has come into LLP, what and all rules are applicable for LLP, what type of regulations have to be complete, what type of provisions to be complied by the LLP. So that is also covered under non-debt instruments. Now, there are other type of investment which are coming. A lot of investments are coming into India for investment trusts. Like real estate investment trusts, REITs are one of the beneficiary, where the government has opened up FDI gates for REITs, where in various type of funds can be invested into this particular. That is also part of what are the process to be followed when any FDI happens in real estate investment trust, or in infrastructure investment trust, or in alternative investment fund trust. These processes have been defined. I'll cover up couple of 1 or 2 cases, because each one is entirely a different process, though everything predominantly follows a particular type of process, but we can understand 1 or 2 to know what are the process to be followed as per these new regulations are concerned. So next one is ETFs. New ETFs is there. Very interesting thing is that acquisition, sale, or dealing directly in immovable property. Immovable property, though it is not an instrument per se, though it cannot be called as a debt instrument, but they are trying to kind of say that it is more of an capital account transaction. They are trying to put all the capital account transaction into one place. So that is why they are kind of adding this immovable property, which is carved out from various places, and putting in non-debt instruments. And contribution to trust is nothing but different types of trust have been placed, and what type of investments can be made there, that has been detailedly explained over there. And depository receipts against the instrument, like basically it is ideas where we can create a underlying asset, and then depository receipts can be issued from there, like convertible notes, and then deposit receipts can be issued. So these are also being carved out under this non-debt instrument. So all this put together is governed under this particular regulation. Sorry. So we'll cover that FPIs and FEIs. What are the specific regulation we need to follow in those cases, and what are the some of the important aspects which we need to cover over there. That we'll just try to glance through it and then understand it. And which are all the other cases which the latest changes have happened is that foreign investment in investing companies earlier registered as NBFC. Now now it is under automatic route. They have made it under automatic route, where the investing companies under NBFCs they can invest. The foreign companies can invest into NBFCs up to 100% on that. Any specific any specific rules they have put in place is that only downstream investment part they have said that the downstream investment has to be that the overall, whenever there's any downstream investment, the downstream investment from these sectors, because whenever any investment happens, the investment companies goes through the foreign investors generally create investing companies or core investing companies, and from there they would like to invest into the NBFC or any other companies. So when it comes to that, we need to understand what is the direct investment limits and indirect. So we need to refer both direct and indirect, foreign FDI, and then we need to, advise the client appropriately. And also, and also in the case of core investment companies, which is where the investment are routed through an investment companies, and those companies which are engaged in investing in Indian companies is permitted only under government route. So the companies has to go through the government approval route. They have to get the approval, and before they proceed into investment into other companies. This is some changes has happened, and some more very important changes is that which is in terms of defense sector. In terms of defense sector, I think the government is wanting to push the manufacturing side of the defense sector. So what they have said is now they have covered earlier the defense sector was up to 49% was under automatic route. Now they said that wherever any sector, any investment which happens, which requires compulsory licensing, which requires the industrial licensing, where any sector which requires compulsory licensing or industrial licensing, under only in those companies, the investment under defense sector can go up to 74%. That means up to 74%, we can go under automatic route. So how do you go into automatic route from 49% to 74%? You need to get an industry license first. Before we go into the 74% automatic route or applying for the automatic route, we need to ensure that the manufacturing setup is there, and we need to apply to the Ministry of Defense for getting the industrial licensing. Only after that, all the infrastructure requirement is complied, all the conditions for which licensing is required is complied. After that, if we apply the industrial license and if you get the industrial license, post that you can convert from 49% to 74%. You cannot convert a company which is under 49% automatic route, go into 74% without getting an industrial license. So the first criteria to get the 74% automatic route is you need to get the industrial license. So basically, they are trying to say that you get a manufacturing setup done, get the all the infrastructure ready which is required for manufacturing of defense related items, and then you can go for 74%. Until then, they restricted is 49%. Those who do not seek to go for the industrial licensing, there are many businesses who is only having a kind of tie-up with many companies outside India. They just only tie up for technology or the franchise the technology, and they just involved on the defense sector. So under those companies, the 49% is still there. The 49% is the maximum at which they can go for it. And for that also, they need to, if it goes more than 49%, they have to go for the mandatory, they have to go for the approval route. Now, when it comes to, they have to file a declaration. That they have to file a declaration in case of, for example, if A is an investor who is holding 49% under automatic route, it does not mean that he can transfer his share to another investor without any, without any process. So whenever there's a change in shareholding happens, and specifically in defense sector, that mandatory submission of declaration for change in shareholding has to happen. So before its shareholding changes from one non-resident to another non-resident, before the share transfer happens, they have to mandatorily file a submission of declaration, and then and that declaration should comply all the existing guideline. For example, the another investee should not be a investee which is a beneficial owners of the bordering countries. Those restrictions has to be looked into it. So those declarations are important. That subject to that, the transfer can happen. And very important, which I have clearly said also specifically in defense sector, that any investments which are under automatic route, even if it is under automatic route, if any sectors which any investment which affects the national security, which affects or any ground which affects the national security, any investment which affects the national security, whether it is under automatic route or under government route, the government, the Ministry of Defense can take up for review of those applications, the review of the company transaction, review of the transaction which they are doing, review of the businesses which they are carrying on, and they can take up for further action. So this is one thing which they categorically mentioned. So we need to understand that and take it forward. I think on the broadcasting side, I clearly explained already what are the permitted activities. Up to 26% in the content service sector, up to 26% is permitted specifically for uploading or streaming of news and current affairs through digital media. And those whenever an application is made, a clear clarity has to be there in the businesses. The clear clarity has to be there whenever we are making an application to the government. There must be a clear, if there's an existing company, and they are into multiple activities in the same digital media or multiple activities in the broadcasting side, I think there should be a clear clarity has to be established to the government to segregate which is 26% is allowed, which is which is allowed and which is not allowed, so that there is a clear identification by the government agencies that it does not violate the other regulation, it does not violate the conditions which has put in place. If we are not clearly establishing that, there is a very good chance that the application will be rejected and we will not be able to carry forward the businesses. So whenever there are sectors which are sensitive sectors where there's a combination of automatic and approval route is there, we need to ensure that there's a clear clarity. For the simple, if we have to structure it better, we should always go for a clean structuring. That means you can always create a new company, you can always create a new structure where you can always go for the approval, where you can always clearly establish them, that the investors who are the beneficial ownership, and it will be very clear for the government to establish the beneficial ownership and things like that. Later, when things are much opened up, then you can always merge it, or you can always transfer it to the another media and things like that. So that is very important when we are structuring the transactions. Now, as I explained on the real estate sector, the real estate sector's clarification has been received that real estate broking is not part of the real estate activities. So anybody who is engaging in, there are many companies who are like there are many Cushman and Wakefield, there are many companies who are purely on broking side of it, but they were getting a lot of funds from outside India. There were a lot of clarity missing on the whether they are part of the regulation, whether they can deal in buying and selling of sites, buying and selling of plots. So there were a lot of clarity missing. I think clarification has been received. Now there is a clear-cut differentiation between real estate business and the real estate broking, and also the real estate construction and infrastructure, all these things. So that clarity has been brought in by the government. So that will help in terms of redefining the business and things like that. So we will try to cover one or two aspects of the non-debt instruments, which are all the segments which we need to understand in terms of the investment and all. So before going to that, I would like to also add in terms of the FDI process. FDI process, I think many of them might be already knowing it, but for the benefit of as a revision. So whenever there's an investment is received, whenever there's any investment is received under automatic route, what happens is under automatic route, you will get the first funds. when you get the first funds into the bank account, so banker will ask you, the authorized dealer will ask you that what is the reason why this fund has come into the bank account. So whenever there will be certain codes where you need to declare for what reason it has come. If it has come for as an FDI, then you have to clearly explain that foreign direct investment by a person resident outside India. So there will be a particular codes will be there. You need to ensure that right codes have been put in place so that there is no hassle either at the time of allotting shares, either at the time of refunding the amount, and these things. So whenever you get when you make a declaration, the bank will generate the FIRC certificate. The bank will generate the FIRC certificate. This FIRC certificate, you need to verify that FIRC certificate very importantly, because it will provide you the amount which is the amount which has been received. So when you receive the amount, you might wonder is there may be certain issues in that FIRC certificate. One is you might wonder that the investor would have said that he would have sent $100,000, but the amount would have come $99,950. So that is one such issue will come into place. Second issue is that they would have brought 100,000 and they would have paid exactly 7. They would have thought that the current bank rate is 82 rupees and 82 lakhs will come in place, and 82 lakhs is the amount which is supposed to be required for allotment of shares. But instead of 82 lakhs, we have got some 81,80,000 rupees because of reduction because of the foreign currency variation, or because of the charges, or because of the bank buying and selling rates. It could be many reasons. So that is another reason where the FDI amount becomes shorter than what is supposed to be received. So these aspects to be looked into it. And if it required, if it falls short, immediately you should ask the investor to fund for it. So that is one important area which you need to look into it. Second very important area is the codes in which the banker issues the FDI is very important. If we say that foreign direct investment by person resident outside India, that means it's a clear FDI case where it will help you for the allotment of share. There will not be any misuse. There will not be any issue which can happen at a later stage. For example, if for some reason that the code is not being properly mentioned, you would have given the code, this has to be mentioned by the investor, but the investor does not mention, whenever he is making payment from his account, he does not mention the code properly. In that case, what happens is, some code will come, maybe they say it as an investment purpose, or maybe they say general word like shares, purchase of shares kind of thing. So in those circumstances, if there is no proper code will be there, then the banker will have a challenge in appropriating to a particular code. So then you might have to do the further paperwork to give a declaration, get the documentation from the investor that this is for this purpose only. By mistake, this particular code has been mentioned like this. So these are all the difficulties which you face. I think you need to understand this in advance and make sure that you clearly direct the investor that he has to make this investment through this particular code number. And then when he's making the money, he has to make only through SWIFT transfer only. If he does a transfer through telegraphic transfer or any other direct transfer, which does not validate the KYC of the investor, then it becomes a very difficult for the local bank or the authorized dealer to issue a proper FIRC certificate. He will not be able to issue unless the KYC is validated. So in those circumstances, we need to direct to the investor properly and make sure that he follows that guideline clearly. So that is when it comes to the receipt of funds. After you receipt of funds, we need to ensure that 60 days. We need to ensure that 60 days. We need to ensure that within 60 days, we need to allot shares as per Companies Act is concerned. You get only 60 days as per Companies Act, even though under FEMA it is about 180 days. But there is always a kind of a gap because that rationalization is still not there, where 60 days. So many of the times which we said that we are allotting within 60 days. So within 60 days, we need to allot shares. When we allot shares, we need to file a FCGPR with the government. Now it's all online process. So we need to follow the FCGPR process. So for filing through FCGPR, before you go through the FCGPR process, I think certain important guidelines to be fulfilled. One is number of shares which you need to allot, that the valuation has to be done. The valuation has to be done. There is a simple regulation which clearly says that the value at which we allot the share to the foreign resident, the value, it should not be less than the value arrived by a valuer. So now the valuer could be a merchant banker or a chartered accountant, depending on the method at which the valuation happens. So that the valuation based on the value at which the shares are allotted, the FCGPR number of shares to be calculated, and then all other process like obtaining the company secretary certificate for all the company law process, all that has to be fulfilled, and complaints to be taken care at the RBI portal. So this is what it happens when it comes to the allotment of shares, and those allotment of shares has to be done, and once you complete the process, share certificate has to be issued to the investors. So this is what happens when it comes to the FDI process for FCGPR. Now there are other situations which also comes, is that there's a transfer of share between a resident to a non-resident. So that means the originally shares were transferred to the resident. Originally shares were held by a resident. The first scenario which we covered is shares were issued directly from a company to the non-resident. So that is the first scenario. Now the second scenario is shares are already held by a resident and he would like to transfer it to another to a non-resident. In those cases, the person who is supposed to take care of the complaints is the resident individual investor or the person who is selling the shares. So he has to take care of the compliance. So in that case also, if the money has already received to the bank account, same process which I explained for FCGPR in terms of the money receiving and all this thing. The only difference in this FCTRS is, that is, whenever shares are transferred from resident to a non-resident, the FCTRS has to be filed. So in the case of FCTRS, what happens is the shares are received, the funds are received to an individual account. It does not come to a company, it comes to an individual account. The individual investor, what he will do is he will have to follow all the regulations, such as shares has to be allotted to, shares has to be transferred at a price which are not lesser than the price arrived by the valuer. That means if the valuation says that 100 rupees, he cannot transfer the share at 90 rupees. If the valuation is, he cannot undersell it. Basically, what it means is he cannot undersell it. He can sell it at 100 or 150 or 200, depending on the buying and selling between the buyer and seller. So in those cases, what happens is FCTRS has to be filed. So FCTRS has to be filed within 30 days from the date of transfer of shares. So once you receive the funds, within 60 days, you need to allot the, we need to transfer the shares, and then you need to file it with the Government of India. You need to file, though 160 days is there, 180 days is applicable in that case, where the shares has to be transferred within 180 days of the receipt of funds. So if it is not received 180 days, in both the scenario, the company has to repatriate the funds, or the individual has to send it back to the original investor. So he cannot keep it with himself. He has to send it back within 180 days if the shares are not allotted. Now, in FCTRS, he has to individually register in the RBI portal, and he need to file the FCTRS to the government. So he is supposed to ensure that all compliances are taken care. That is in the case of share are transferred from resident to non-resident. There's another scenario where shares are gifted. Shares are gifted. The shares are gifted from a resident to non-resident. Shares are gifted to resident to non-resident. In this scenario, what happens is, one is the gifts has to be made only to a relative. The definition under Section 277 of the Companies Act, they have to comply with Section 277. That means it can be gifted only to the relatives. And there should be a documentation which clearly explains that there should be much before the company registered these transfers for the transfer of gift from a resident to non-resident. Before that register happens in the register of members of the company have to obtain a lot of documentation. One is that the transfer is between a resident and non-resident, and the non-resident is a relative of the resident. That is the first declaration they have to obtain. They have to obtain all the documents relating to the, how they are connected, how they are related, and also the passports of both the persons. And they have to obtain a declaration, that the sectoral cap will not breach. Sectoral cap does not breach. Before the sectoral cap does not breach, all that they have to verify it. And all this, and the value of transfer should not be more than $50,000. So these are all the declarations to be provided by a resident who is transferring to non-resident to the company. Based on those compliances, based on verification by the company, if they find it it's fine, so they can transfer the shares. They can transfer the shares in the name of the non-resident investor. So those are all the aspects which has to be taken care when it comes to the FDI. And another other two aspects of FDI which are recently kind of tweeted is also, which is predominantly now very open, is that whenever there's a investment is done by an NRI. Now what happens? NRI invest into a foreign company. It can be a company, or it can be proprietorship, or it can be partnership and all. So when it comes to non-resident, there are two options for them. Either they can go with a repatriation basis, or they can go with a non-repatriation basis. If they are going with a non-repatriation basis, it will be treated as at par with domestic investment, where they can just transfer it from either from NRE account or from NRO account, or they can also transfer funds from outside India and still treat it as a domestic investment and things like that. And in those particular domestic investments, there's no need to complain. It will be, there is no repatriation benefit at all. So repatriation benefit, I'll come to the repatriation benefit. So when it comes to the non-resident investor who wants to, or NRI or OCI who wants to invest it on repatriation basis, then the same process which is supposed to be followed for a non-resident entity, those same process to be followed. Now, some of the cases where they would like to invest it in partnership forms or proprietorship forms and things like that. In the proprietorship, they cannot invest it on repatriation basis. In the partnership form, also, in my opinion, I think it's they cannot invest it on a repatriation basis. They can invest it on a non-repatriation basis. So that is the aspect which needs to be considered. And in LLP, I think in LLP, sectoral limits has to be, sectoral limits has to be ensured. Sectoral limits has to be ensured, and whenever investment is made in LLPs. So this is the broad aspects of FDI, which needs to be ensured before the investment is made. So I would like to cover some of the important aspects, which is in terms of foreign portfolio investors and things like that. Certain important things has to be kept whenever we are receiving any investments from foreign portfolio investors. One of the thing is whether the foreign portfolio investor is he registered with SEBI. So basically what is this foreign portfolio investment? It's an investment made by person resident outside India through capital investments, where such investment is less than 10% of the post-issue capital of a particular company or particular group, to the extent on an overall basis. So basically why this portfolio investment has come into place is that for companies which are listed, which are these listed companies are very easy, where the sectoral limits and the monitoring of the sectoral limits, breach of these sectoral limits, or the ownership or the beneficial ownership of the foreign investors, cannot be easily tracked. So what government have done is they have made as a 2-3 sector through 2-3 separate registering. Foreign investors can register as a foreign portfolio investors and foreign venture capital investors. So in the foreign portfolio investor, what happens is these foreign portfolio investors will register as one group with SEBI, and they obtain a particular license, and then they are eligible to invest in any listed companies or any companies which are publicly listed. And these which can be invested in capital equity instruments or the convertible debentures, all these things. So these investments are these portfolio investors can invest in these particular instruments. So what is different in normal FDI and this one is because of the kind of in money this foreign portfolio investors have, they can kind of invest into any company and then take over the management, things like that. So because of that reason, and specifically on sectors which are specifically sectors which are sensitive to the government and things like that, so what they have said is they have set the maximum limit to which the foreign portfolio investors can invest. So what they can do is they can invest only up to 10% of the paid up equity share capital on fully diluted basis. That means they have to readjust the investments to the dilution. That means fully dilution basis. That means whatever partly dilutable or based on the future dilution basis, overall fully diluted basis, they cannot go more than 10% of the paid up capital of the company. So those limits have been set in that case. And there are certain specific regulations are also there. So whenever any foreign portfolio investors are there, we need to ensure that they fulfill these conditions before they go into the further investment of it. All other guidelines of investment will remain same, but there is apart from the sectoral cap, they need to also fulfill the cap relating to. They need to also fulfill the cap relating to the investments. Just to cover specific things. Now, whenever any investment happens specifically into FDI, we need to also consider specifically in terms of foreign portfolio investors or maybe core investment companies and all this thing. There is something called direct and non-direct investment. There is a direct and indirect investment. Let us take an example how this direct and indirect investment works. For example, there is an investment trust which is incorporated in US. That investment trust holds a lot of funds, and they create one investment vehicle in India. It could be a private limited company, or it could be a partnership firm, or it could be LLP, or it could be a trust. And these investment companies, investment vehicle, the company which is the investment trust which is sitting outside India will invest up to 70. For example, under automatic route, if it says 74%, so they invest 74% in this investment vehicle, and then from this investment vehicle, they invest another 50% in a particular company. So whenever they directly invest, 74% becomes a direct investment, and this 50% which they are indirectly investing through the Indian company, that becomes an indirect investment. So whenever FEMA to be read, we need to understand what is direct investment and what is indirect investment. This indirect investment is typically is termed as downstream investment. So there is a specifically detailed regulations are there for downstream investment. There are a lot of conditions are there for downstream investments. So the downstream investment, the basic and simple premise of the downstream investment is that whatever the investment happens, the sectoral breach cannot be the overall investment of that particular investee company should not breach the sectoral breach, including the indirect investment. So it cannot say that, for example, this investment vehicle being an Indian company in nature or being an Indian holder in nature, it cannot say that it's a company which is incorporated in India. So it's an investment from Indian company to another Indian company. So there is no sectoral breach or something. So that because the beneficial ownership of this particular Indian company is held by a foreign company which is sitting outside India. So which is also beneficial ownership of the Indian company, which is a investee company. So the indirect shareholding pattern also to be analyzed. Indirect shareholding pattern also to be looked, and before we receive any downstream investment into that company. Whenever that downstream investment happens, before that they have to go through the detailed structural analysis of the group, and only when they qualify for a downstream investment and they does not breach the sectoral limits or they does not breach any downstream investment guidelines, only under those circumstances they can they can do the investment. This is also equally applicable for this foreign venture capitalist funds also. It is also applicable for foreign portfolio investment also. So when it comes to the pricing for the investments for FPIs and FVICIs, the pricing has to be in line with the because they generally because it is invested into this listed investment trust like REITs, listed investment vehicles like core investment companies, or it could be listed companies itself. So whenever there is a pricing guidelines are there, the pricing guidelines is the internationally, though it says the internationally accepted, but when it is pricing guidelines are available in the live market, the price at which the share should be allotted should not be lesser than the price which is trading in the market, or which is available in the market. So whenever the pricing guidelines has to be fulfilled for the listed companies, they have to ensure that these pricing guidelines are ensured. And also the controlling aspect, when it comes to the controlling aspect, there could be scenarios where there could be a scenario where FPIs are incorporated in countries like UAE, in countries like US, or countries like Singapore or Mauritius, but it are beneficially held. It are beneficially held by Indian resident Indians. Then there is a conflict. Then there is certain restrictions are there, because it amounts to reverse FDI. So there are reverse FDIs are not allowed, and there are a lot of conditions have to be fulfilled. So when it comes to the, that is why we always go back whenever we talk about any foreign investments nowadays. We always talk about beneficial ownership. We need to validate the beneficial ownership so that we don't get into the hassle with the government. So whenever there is a investment trust or any investment which comes to FDI into Indian companies, we have to ensure that it is not beneficially held, that the investment vehicles are not beneficially held by Indian residents, so that it amounts to reverse FDI, which is not allowed. So those kind of aspects has to be looked into it, and specific guidelines has to be looked into it before we go for any advising on these areas. So these are all the specific issues which we need to take care, and these are all the important aspects we need to take care in these areas, and we have to ensure that we comply to these guidelines. So I think predominantly, we kind of there are many small changes are there, and there are many detailed process have been amended, but these are all detailedly explained in the consolidated policy. And I think any specific issues are there, we can deal through it. But when it comes to FDI, specifically on the FEMA part, it has been fairly simplified now. It's specifically going into the particular sector. First, you need to understand which sector the business falls into place. Go to the specific sector, go to that specific sector guidelines. You go to the specific sector guidelines, you verify the specific condition, is there any specific conditions, and then you go back to the eligible and investee or the investment, whether the eligible investees are there, whether eligible investors are there, that eligible investors who are the beneficial owners are there. So you can go back to those some kind of checklist, and then verify that process, verify those steps, whether they are fulfilling those specific guidelines. And then you can go into the next on advisory of structuring the FDI and obtaining the permission from the, permission if it required from government, or if it is under automatic route, make sure that all the process which is required for automatic route is fulfilled. I think one of the another important aspect which I just thought I'll update you is that we need to create the user ID password for all the entities. We need to clear it in the RBI portal, so that whenever you are filing FLAs on a yearly basis, it will be easy. You need to create an entity and user business entity, user master, the business user and entity master you need to create, so that it will be easy for you to file the returns on a whether it is FCGPR or all these things can happen through this portal. So you make sure that these things are kept in place, and then you can it will be easy for you to follow the FDI process. So I think from my side, whatever I wanted to cover in my mind, I think I fairly covered from my point of view. If you have any specific questions, if you have any specific clarifications, I'm open to questions. Hello. I think before from the institute somebody takes over, I would like to see the questions which have been mentioned. I would like to read out and explain things like that. So I think Ms. Bhamini has asked if foreign entity wants to lease out equipment to Indian entity, is this allowed under FEMA or RBI? Likewise, if the foreign entity wants to have a 100% subsidiary which will lease out the locally procured equipment to another Indian entity, is it possible? Any RBI or CG approval is required. See, I think first one is like, if I understand it clearly, there is a foreign entity who wants to lease out equipment to Indian entity. Okay, one is leasing out of equipments to Indian entities. There are two aspects will come into place. One is if there is any if it's purely a current account transaction, there are two aspects will come into place. One is if there is no question of buying and selling of machinery or financing of the it does not amount to financing activity. If it does not amount to financing activity, if it's purely leasing out this one, then it is allowed. But if it amounts, because see, leasing activity is governed by RBI, which is governed under RBI, which is more of an NBFC activities. Okay, so whenever you are leasing out the equipment, which more in the nature of financing activity, then it amounts to then you cannot do it directly. You need to go through the RBI route and things like that. But if you are, for example, there could be a scenario where for example, there is a high technology machinery which is only held by the parent company, and you have been asked to produce those items through the machinery. Okay, where it is more in the nature of where you are giving the machinery is only to help the Indian subsidiary to manufacture it and sell it back to them, and it's more on the contract manufacturing aspect. In that segment, where there is no element of financing activity or leasing in terms of financing activities is involved, in those cases it is allowed. It's purely whether it forms part of capital account transaction or it forms part of current account transaction, depends on the terms and condition. It depends on the terms and condition, and if the terms and conditions does not fit into the leasing or financing aspect, then it is possibly allowed. Otherwise, you need to go for the specific approval with the RBI, and then to be on the safer side, if you cannot structure it properly and you feel that there is no clarity in the terms and condition, it is better to go to the RBI, seek a specific permission. If they allow, then it is better to go through that approval route. Second is there is another question which comes from Mr. Anil Kumar. Equity shares are issued to a resident who then becomes a non-resident and transfers the shares to foreign national citizen, whether FCTRS filing is applicable. Now, I think this is a very interesting scenario which generally happens nowadays because of the global we have been global citizens now. In this scenario, what happens is when the shares are allotted, that person is a resident. When he moves out of India, he becomes either a non-resident. First, he becomes a non-resident, and if he gives up the citizenship, he becomes a non-resident foreign national or a non-resident person. So in that case, there are two options which is available. There is something called NRIs, where even though they give up the citizenship, they still qualify as a non-resident Indian. Okay, they still qualify as a non-resident Indian. In that case, there is an option to hold the shares on repatriation basis and non-repatriation basis. If the person chooses to hold it on non-repatriation basis, then it will be treated at par with the domestic investment. He need not go through the FCTRS filing and things like that. Where on the transfer of shares, he need not go through the FCTRS because he is holding that investment. He is holding that investment at the time of holding the investment. He need not file the FCTRS because he is holding as an investment as a domestic investment. Now, for example, now he holds it as a resident investment, but he transfer it to a non-resident foreign national or non-resident sitting outside India. Then he has to then he cannot transfer it because it it is not a repatriable instrument at that point in time. So, for example, if he is holding as a domestic investment, first he need to if he is becoming a non-resident, then then there is no question of FCTRS will come, because he becomes a non-resident, and the transfer from non-resident to non-resident, there is no form is available. So transferring from non-resident to non-resident, there is no filing is required. Converting his resident to non-resident investment also, there is no form or anything is applicable. But only thing is, whenever you are becoming from resident and non-resident, and specifically in sectors where there are sectoral caps are involved, that is where the care has to be taken. For example, suppose you have one startup which is into defense sector or space sector, where it is 74% is allowed under automatic approval route, or 49% is allowed under automatic approval, and beyond 49% you need to go for a specific approval. Now you are holding as a resident, and for 51% you are holding, and 49%, and suddenly you wanted to become a non-resident, then this 51% will be under question. So you cannot do that. You cannot become a non-resident, and you cannot become a non-resident entity unless you seek a specific permission, and then seek a specific permission only on approval you can do that. So you need to clearly identify under which company you are holding a shares, and whether by becoming non-resident, whether it impacts my sectoral cap or it impacts my foreign FDI. If it impacts, you need to take care of it. If it does not impact, then it doesn't matter. If it's under automatic approval, doesn't matter. Okay. So now the next question is, I think question is in relating to LRS, whether an individual can invest in foreign companies if yes, and whether the same can be transferred to foreign trust without any approval. See, first is, I think when it comes to investment outside India, even though you might do under LRS, but you need to comply with the overseas direct investments, ODI regulations. You need to follow all the ODI regulations. And then under ODI regulation, there are a lot of conditions are there. Though you can invest it predominantly into this one, when you are further transferring it from that company to another company, you need to fulfill the guidelines, where the disinvestment issue will come into place, ODI. So those specific guidelines you need to fulfill when it comes to. So LRS by itself does not mean that you can just invest in foreign company and you need not report. It doesn't hold good like that. When it comes to LRS has to be read in line with ODI regulation. And in ODI, there is a specific provision which clearly say that you need to first, when you're doing ODI, you need to get a UAN number, and then you have to do the investments. So that's something which you need to take care of it. Whether single layer of downstream investment amounts to round tripping. See, round tripping is a different concept. It has to be single layer downstream investment. If the downstream investment, I think if you look at the ODA guidelines also, there is a very clear direction, I think, which clearly talks about whenever there is an investment, further downstream investment to an operating activity, and if you are able to fulfill that it is operating activity is there, and first level of downstream investment is permitted if it is an operating activity. Now, if you are structuring in such a way where this further round tripping will happen, that means you invest further from that company to another holding company or to another parent company, then definitely if that activity is not connected, then it amounts to round tripping. So you need to be careful about whenever you are doing downstream investment. Downstream investment has to be read in line with ODA guidelines also, where downstream round tripping needs to be where it qualifies as round tripping. You need to avoid that. What would be the normal timelines for RBI approval? It depends on the which sector we are asking. See, I think when it comes to, as we know, RBI approval is only in relation to specific, if it's sectoral gap, it goes to the, for FIF, that foreign facilitation investment portal or something, it goes there, that it can be between 45 days to 6 months, depending on the type of structure. But when it comes to RBI, RBI approval will be, various steps of approval will be there. It can go from 1 month to even 6 months, or you may up to 6 months. Generally, you get some reply. If there is generally it will take 30 days. It depends on the complexity of the case. If there is no specific guideline, you get a RBI rejection. They don't approve anything which is very specific. So general timelines is about 30 days. I feel in my opinion. And amount payable to non-resident, not paid, non-resident liquidated. What is the process to write off? I think this is governed under export and import of goods and services. There is a separate master circular on that. Just to explain to you in this aspect, this is one of the most one of the area which is most practical issues have been faced in last decade. There has been no particular though there is no particular solution for it, but I would like to say that the master circular is very, very clear. They have clearly explained what is the process to be followed. They clearly explained that what is the process to be followed for that. For import, in the case of payable to non-resident, the write-off is generally not allowed. The write-off is not generally allowed. In case of a loan or this one, only only in the case of if you prove that you are unable to pay, so that the payments are allowed. If you are asking for export where you have exported and non-resident is unable to pay, then there is a specific guideline in that, and that you have to follow through that specific guideline, where you need to write to them, you need to make an effort, you need to prove to the RBI that you made all the efforts and they have run away. All those specifically they have given the guideline. You need to give that, and in spite of that, I think you can seek a specific approval to the RBI that you are unable to get the payment, and you seek an approval for write-off. And there is also up to a particular amount, they have clearly mentioned up to a particular amount they can write off. And beyond that, I think there are a lot of practical challenges. We are not getting right approvals from the RBI. So you need to wait and watch if we get any guidelines clearly in that area. The next question is relating to Mr. Girisha has said, a small extra amount of FDI received due to extended different. This can be even, we can write it to the RBI or to the authorized dealer. We don't need to write to RBI. We can write it to the authorized dealer, saying that suppose if we have, for example, we have received 10 lakhs, we have received 10 lakhs 100 rupees or 10 lakhs 500 rupees, and where you can say that 10 lakhs has been allotted and 500 rupees you are unable to allot. You can write it to the authorized dealer, saying that we will be adjusting this 500 rupees towards bank charges, because the amount of the cost of transfer of this 500 rupees back to the original investor is higher than the amount which is available. So under those specific circumstances, by writing to the bank will not give you any specific letter or something. At least you have something to retain, and you can write it off in the books of account, saying there's bank charges or maybe some miscellaneous income and things like that. So that is being predominantly allowed, and you can also go through that mechanism where you can write off the small exchange rate differences and things like that. I think on the next question, it is coming from Aishwarya. If I'm establishing a wholly owned subsidiary in India by a foreign company and receiving FDI, whether wholly owned subsidiary needs to file FC1 as per Companies Act to ROC. See, FC1 is, I think, to my understanding, is applicable only in case of branch, liaison office, and project office. Okay, I feel it is applicable only in those cases. If you're incorporating a wholly owned subsidiary, see, when you incorporate a wholly owned subsidiary, you are going to the RBI only. You are going to the RBI. You are going to the ROC only, that these are all the shareholders and these are all the beneficial owners. These are all the directors, and this is the shareholding pattern. All that you're already doing it to the ROC. So again going to FC1 to the ROC is not required. That is only applicable. That's a foreign entity. When you don't want to create a wholly owned subsidiary in India, where you want to go through the branch route, or where you want to go through the project office route, where you want to go through the liaison office route. At that scenario, after you getting the approval from RBI, you need to go to the ROC for FC1 registration. That's only it will become a foreign entity. Then only it is termed as foreign entity. Manish Agarwal, which master circular? I'm unable to understand your question. If you could detail it out, I will be able to answer it. So is there any maximum limit in a FEMA for excess amount that we receive towards FDI due to Forex fluctuation? There is no such a limit. See, whenever there's no such limit actually, but there must be a reasonable, for example, let me take an example. Suppose you are investing you are getting $100,000 into India, and the maximum variation could be 1 or 2%. For example, 100,000, 70 lakhs, you might get 70 lakh 7,000, or maybe 70 lakh 14,000. That is still a reasonable 1 or 2%. But if it goes beyond that, definitely you need to send that money back. And then settle your repatriation account, settle your FDI account. Amount payable to non-resident. No, this master circular is there on export of goods and services. Export and import of goods and services. I think there's one master circular is there. I can, if you touch base specifically with me, I can give you it's quite there. You can Google it also, master circular on export of goods and services. It's quite there. We clearly provide the list, how they can do it and things like that. Any other questions or any other points which
I think there is no question in charts. I think on
charts are not there. If you can open up for audio if possible, I think that is also, we can spend some 15 minutes and then we can take up if anything is there.
If any question is there, please.
There are in webinar there are some 3 questions, Chairman.
Okay.
One is I think Mahesh TR is asking about safe agreements. I think I request you to elaborate so that I can answer it. Can we get the list? What activities required to go through approval route and what activities can go through automatic route? As I explained you, I think predominantly all activities are under approval. All activities are under automatic route. I would like to explain to you which I would say that which are under specifically under approval route. One is sector wise. I can say one is defense. Defense is under automatic approval route. Second one is mining, specifically in titanium mining, it is under approval route. Not that you need to have a separate percentages also there, but you need to go through it specifically. There's a print media which is under approval route. You need to be cautious on print media. Broadcasting, in the broadcasting aspect, content creation is under automatic approval route. But however, the carriage service, that is broadcasting carriage services, is under automatic route. And another sector which it comes to my mind is about I think this is about retail trading. Single multi-brand retail trading is under government approval, which is about this one. And also that inventory-based model, e-commerce FDI is not permitted. This is something that we need to be clear. FDI in inventory-based model is not allowed. I think that's a couple of structures. That's a couple of sectors only where you have this. I think is under government. Banking, just to add, banking is under government route. Specifically banking in the sense banks, specifically SBI and other associate banks. Those specific banks you are under approval route. And there are some insurance infrastructure companies more than 49% is under approval route. Pension sector is under more than 49% is under approval route. And power exchanges, like, setting up of power exchanges, that is more than 49% is under approval route. These are all the broad sectors which are under approval route. And prohibited sectors, which I have already clearly said, prohibited sectors are also there. So specifically on farmhouses, plantations. Plantation means agricultural activity. Plantation is allowed, specifically, like tea plantation, coffee plantation, palm oil plantation, and even plantation under controlled environments, which is like, hydroponic and all these new technologies which are coming in agriculture. Those are all allowed under automatic route, and that is generally allowed. Can business expenses payments can be made through international credit card? Is it allowed? See, these business expenses payments are all coming under LRS. If you are a resident person, all this comes under LRS, 250,000 yearly. So up to 250,000, all these expenses are generally allowed. I think that predominantly answers.
Equity shares are issued to, one question from Anil Kumar.
Okay.
Equity shares are issued to a resident who then becomes a non-resident and transfers the shares to a foreign national or citizen, whether FCTRS.
I think that I have answered.
Answered, I think, okay.
I think there is another two questions in question.
Question: can business expense payments can be made through? Okay, that is done.
Just now.
Is there any specific differentiation between financial lease and operational lease given under FEMA regulations notifications? Please let us know, where do we get this?
No, I think in my understanding, with my knowledge, I feel there is no separate segregation between finance lease and operating lease. Lease activities are predominantly covered under RBI. You need to go with a specific approval from RBI. If you get a specific approval from RBI, you can conduct both operating lease and finance lease. That is only from an RBI point of view. If you get a RBI permission, where there is a for NBFC, see, if you see the sector, NBFC now up to 100% automatic approval is allowed, unless there is a specific if we get a specific approval from RBI, you can conduct the operating lease or finance lease. In my opinion, there is no segregation over there.
Is R&D, health sector and manufacture of devices such as air purifier, etc. under automatic route?
Yes, all manufacturing activities except defense, except except defense manufacturing sector, predominantly all comes under automatic route. Manufacturing of devices like R&D in health sector, these are all part of the automatic route. I don't see any restriction over there.
Okay. I think all the questions is over, I think. Members, if you have any one or two questions, you can ask, otherwise we can conclude. With the hope you have got clarified with all your doubts. Thank you, Santhosh, for an excellent presentation. I know it is a Herculean task giving a 2-hour session and ask you to update entire changes in FDI. Really, you have taken a great task, and it was a very active session. Members also asked so many questions. Really, I thank you on behalf of Bangalore branch of ICA for your efforts in sharing your time and knowledge. Thank you.
Thank you so much. Thank you for this opportunity. Thank you. Thank you, everyone.
I thank all the members for active participation. Thank you all.
One more message, I think it came. I think.
Thank you.
Thank you.
Thank you too.
Bye.
Bye. Thanks.